Our next guest says, don't trust the tech bounce. We've seen these last few weeks. Joining us now, Annandale Capital founder and chairman George Seay. George, good morning to you. I'm sure you just heard that discussion with Steve Leisman. If Fed Chair Powell doesn't have to do much fixing, as Leisman put it, and the rally has continued at the same time that bond yields have moved up, what could ruin this rally here?
Hi, Deirdre. Well, there's so many things that could ruin the rally. The animal spirits are back. The art complex is moving up fast and furious, and everybody wants to go up and to the right. And what we hope is going to happen and what actually happens rarely align themselves. And does Chairman Powell really have to stop at a 5 to 5.25 range, or could he go higher than that? Well, the market is predicting he's going to stop there or even earlier than that. And he certainly doesn't have to if he doesn't like it, jobs numbers and inflation creeping back. So I think that people who are putting on their animal spirits hats again may be a little premature and might want to take some risk off or hedge their bets a little bit.
Okay, George, how do you judge the quality of this rally then? I know a lot has been made about some of the low quality, unprofitable names have seen a surge, but we also saw the mega cap tech companies post results that, yes, they weren't all that great, but it seems to be baked in because they've also regained their leadership this year.
This market reminds me a lot more, Deidre, of 2000 to 2002 than 2007 to 2009. I don't think the valuations were as extreme now as they were back then. In fact, I think quantitatively you can make that as a certainty. But I do think we had a lot of false starts in that 2.5-year period before we finally left that bear market behind. And I think this is probably a false start. I think it's going to take us more churning and more working out where multiples settle down towards more where earnings growth is, and earnings growth is slowing, and I think the multiples have still got some workout to do left. So going right back off to the races, I question that. I just don't think that's going to hold.
Yeah, George, that's curious. I mean, people have talked about, the fear about earnings revisions being pretty tough, but there have been some high-profile cases of Spotify and Netflix and Meta where revisions went the other way. Do you think that eventually does turn back, though, to the downside?
I think it depends on the company, Carl. You got to go company basis on a one-to-one analysis, and there's such a mixed batch of earnings we've been seeing. Some companies have surprised the upside. The Meta reaction was euphoric. It was really powerful, and I'm glad I'm a stockholder, but I'm also a stockholder of Amazon, and it got absolutely drilled last week, and I hope it gets drilled a lot more so I can buy a lot more, a lot lower, but it's very company specific, and that's not a super healthy market. You want to see breadth. And right now, we're seeing a lot of speculative tech breadth and among the blue chips, as Deirdre said as well. But I just don't think it's sustainable. I think we're going to have a lot of starting and stopping and a lot of chop. And I think a lot of young investors who didn't go through the Great Recession or the tech bubble bursting are not used to a market that doesn't just go up and to the right like we've seen for over a decade. And this is going to be a different period of time, I think. And I think active investors have got a leg up for the first time in a long time.